Well, for those of you watching remotely, welcome. And today we're going to be clearing up the remaining topics on the syllabus that we need to worry about. I'm skipping some minor topics that you don't have to worry about. So we'll have a few topics here coming up today. And when we think about where we left off last class, we were talking about some special reports. So we talked about things like other comprehensive basis of accounting. We talked about supplemental compliance reports. We talked about reports on the application of accounting principles, things like that. So the first thing we'll do today is to get back into that handout and take care of the remaining topics on it. And handout here. I think now what I called it. Bear with me a moment and I will find it. There we go. There we go. All righty. So here are special reports. We had gone through the first section of this. Also the second section, which is type special report, reports on the application of accounting principles. We saw that was a strange one. That's okay. There's a short case, which we'll do on Wednesday. And then what I would like for us to do today is to take a look at this really short one to start off, which is about summary financial statements. AUC 810. AU standing for auditing section and C standing for clarified. So with this, I have a few copies left of the handout. Does anybody still need a paper copy? It's the same one that had special reports on it. Anyone at all? Okay, very good. So summary financial statements. Well, this is when we don't need a full-blown set of financials. Instead, we just need them summarized. So maybe instead of listing every single current asset, maybe a summary balance sheet, but only lists total current assets, total long-term assets, etc. Instead of listing all categories of revenues, a summary income statement might just have one line item for revenue. You get the picture. So try to get back on detail. Now, summary financial statements are supposed to be read in conjunction with the full-blown, unsummarized financials. I think every guy always does. No, we'll have a warning in there. Just so that everybody's covered. Only read these in conjunction with the regular financial statements. Now, with summary financials, companies often put them out, and there is an optional engagement for which they can engage the auditor. Now, optional engagement is to take a look at those summary financials and make sure they are consistent with the full-blown financial statements from which they come. So take a look at those summary financials, make sure they are consistent with the full-blown financial statements from which they come. Again, that's optional. Nobody says do it. The SEC certainly does not. Just text. Sure, my other meeting I'm supposed to be in 4:30 is okay. I told them I'm not going because I've got class. It's really nice when they schedule things on top of my class, but oh well. Now they sell a doodle poll for it, but it's grad council, and since I'm not on that as a committee member, I wasn't included in the doodle poll, even though I was supposed to be there. So I was forgotten about. So again, this is an entirely optional engagement that we will see here. It's designed to give readers those summary financial statements a little bit of assurance. That's all. And of course, it costs money. That's why it's not too terribly common. So let's take a look here at summary financials. And for those of you online, I'm going to share my screen. If you're online, it looks just like this. And it's in the handout, which starts off with special reports at the top. So a little introduction. So you see this statement's really short, sweet, simple. Well, summary financials are presented in considerably less detail than financial statements which are in accordance with GAAP. And the client may ask the auditor to report on the summary financials in order to give assurance on them. Again, it has assurance that they conform to the basic financial statements from which they come, not that they're in accordance with GAAP. Then B, the auditor may accept this engagement only if he or she has audited the full-blown financials. May not accept this engagement if he or she gave the full-blown financials a disclaimer or an adverse opinion, one of those really bad things. Then we can't do it, because if the full-blown financial statements are that messed up, it doesn't make sense to have these summary financials, which will be messed up too. And see, the auditor must obtain management representations for the summary financials. We've already done that for the full-blown financials, but we'll have one additional representation. That is, the management believes the summary financial statements are consistent with the basic financial statements from which they come. So management believes those summary financial statements are consistent with the full-blown financials from which they come. Well, then reporting on these summary financials. Well, when the auditors concluded that a clean opinion on the summary financials is appropriate, the auditor's opinions state that the summary financials are consistent in all material respects with the audited, full-blown financial statements from which they've been derived in accordance with the applied criteria such as GAAP. Whatever basis of full-blown financials are on, usually GAAP. So notice we're not giving an opinion that those summary financial statements are in accordance with GAAP, but only that they are in accordance with the full-blown financials which they came. So they're a good summary. Then B, if those summary financial statements are not consistent with the full-blown financials in all material respects, the auditor should ask that management correct the summary financials. And if management refuses, then the auditor should express an adverse opinion on the summary financials. Heaven forbid. I don't think many clients are going to allow that to happen. The auditor comes in to do this optional engagement, and then they say to the auditor, well, we refuse to correct the summary financials, even though you showed us where they're wrong. No, just doesn't happen. And C, we always warn everybody that the summary financial statement should be read in conjunction with the full-blown financials, because summary financials just don't have enough detail in them. GAAP, quite frankly, doesn't like them too much because they're not in accordance with GAAP. So we always have that warning there so that nobody is confused. Nobody can say, oops, we thought these summary financials represented GAAP financials. No way. So any questions there about summary financial statements? Now, while I'm on this topic, there are a couple of other very small statements that I have in the syllabus for this unit of material. And those are AUC 720 and 725. I'm just going to cover them with you here together. I don't have a handout, but they're so very short. So those of you online, I'm going to go ahead and stop my share. Word space there. First of all, AUC 720, other information accompanying audited financial statements. We mentioned this briefly before, but with other information accompanying audited financial statements, we're talking about things outside of regular footnote and parenthetical disclosure. Regular footnote and parenthetical disclosure is an integral part of the financial statements. GAAP says so. So we're not talking about the usual disclosure. We're talking about things such as management's write-up for investors of how the company's doing. We could be talking about management's discussion and analysis of the financial statements, which we've discussed a bit before. But that is a required section of Form 10K where management talks about the year through their own eyes. So while other information may accompany on to financial statements. That's what we mean here. Now, in any event, we always read the other information. We make sure it is consistent with the basic financial statements in which it came, just like summary financials. So we always read the other information. We make sure it is consistent with the basic financial statements from which it came. And if not, we ask management to correct it. If not, we ask management to correct the other information. Oh, good. I'm covered for the meeting. Because I'm the department chair and MAC director, and sometimes they forget I also do a little thing called teach. That's why it happens when I have dual responsibilities. If management refuses to correct the other information, we can actually qualify the audit opinion on the full-blown financials, or even give an adverse opinion. So if management refuses to correct the other information, we can do something about that opinion on the full-blown financials. We can qualify it, say the other information is not consistent, or in a worst case scenario, we could make it adverse. How many clients do you think want that? They don't. They'll fix the other information. But shall we say we've got this really powerful tool to convince them? Now, there's also an engagement in which management can pay us to mention in our report that the other information is consistent with the full-blown financial statements in which it came. They have to pay us to do that. So we really do the same thing that we do anyway in that engagement, except we also give a report and we get paid for it. That's kind of profitable. So management elects, and it's totally up to them. Nobody requires it. They can have us report on the other information and give an opinion that we believe the other information is consistent with the basic financial statements. And something else that's very short, sweet, and simple. AUC 725. Accountants are always OCD. Oh, I started to leave off my colon. Now, if I continue to leave that off, how many of you would that bother? I don't believe that. No. Next time I'm going to leave something off and just really annoy you, except it's the end of the semester. That makes something a day.
That's like really annoying.
What's
They
that?
were like slanted.
Yeah,
Sitting at the bottom of the board.
very
And, like,
much.
Finish it going down.
Yeah.
So it's like,
Yeah.
Yeah.
And I'll tell you what that's often reflecting is astigmatism. Yeah. So I have to watch it myself. I have astigmatism. So supplementary information. Well, with audited financial statements, management can include any so-called supplementary information it wishes to supplement the financial statements that is. So management can include any supplementary information, supplemental information, actually, as they call them, the SASs, any supplemental information pertaining to the audited financials. Now, again, we're not talking about footnote disclosure or parenthetical disclosure. Those are a part of the financials required by GAAP. But we're talking about something else, kind of like other information, really. One of the most common things I see with this is a schedule of consolidating information. And you'll learn about that when you take Accounting 6400, which is Advanced Financial Accounting. So in there, you'll discuss this. And there are other types of supplementary information too, but whatever it may be, such as with Florida Institute of CPA Scholarship Foundation, we are a subsidiary of the full-blown FICPA organization. So there is a schedule of supplementary information in our financial statements. It just shows how we jibe with the full-blown financials as we were consolidated with the full-blown financials. In other words, placed in there too. Kind of a good explanation until you take advanced financial accounting. Here at Florida Southern, we also have a schedule of consolidating information, and that is with the Polk Art Museum because we now own it. So with supplementary information like this, the auditor always indicates the degree of responsibility they are taking with respect to supplementary information. We always indicate the degree of responsibility we are taking with respect to supplementary information. Sometimes it is no responsibility. In fact, most of the time it's no responsibility. But we just indicate that. We would give, in other words, a disclaimer of responsibility. So we can give a disclaimer of responsibility. At other times, though, the client engages us to report on the supplementary information. So it's a client option. No one makes them do it. They can engage us to report on the supplementary information. We will report whether it is consistent with the basic financial statements from which it comes. So that's not surprising. Not surprising at all. Sounds like just what we covered before. We will give an opinion as to whether we think the supplementary information is consistent with the basic financial statements from which it comes. Not that it's consistent with GAAP, certainly. And takes care of this supplemental information. Any questions on this? Ready? Of course.
is there a 7.1?
No. No, there aren't. They skip around sometimes.
Okay, good. I was gonna say, it's just.
It's OCD. Yes, I understand. Alrighty. Next thing I'd like to do is go to AUC 920, letters for underwriters. Here's the handout. Does anybody here need a paper copy of it? Well, first of all, before we get into this, who do you think an underwriter is? For those of you online, let me go ahead and share my screen. So you'll see the handout looking just like this. So what's an underwriter? Does anybody know? I heard the term underwriter. Okay. Yeah, there are underwriters in insurance. Absolutely. Yes. Okay, you want paper copy. So there are underwriters in insurance and in mortgage writing. Helen, go ahead. They are. Yes. So, for example, is this a good person to issue a mortgage to? Is this a good person to issue an insurance policy? For example, they don't distribute it. Arson.
So where's the, is that based on the back? What has nothing to do with computer?
Well, we're not going to talk about those types of things. So we will talk about insurance underwriters or loan underwriters. Of course, the best deal with confidence. What the type of underwriter is, we'll talk about today, is someone who underwrites the issuance of securities, bonds, stock, so underwriting the issuance of securities. Here's what happens under normal circumstances. We have a corporation who's issuing bonds or stock. Well, there are direct investment plans in which corporations sell stock to individual investors. I'm not sure about bonds, but definitely stock. So there are those, but those are not the bulk of securities trading. The bulk of securities trading is done through underwriters. So this underwriter is going to buy the securities from the corporation issuing them and then turn around and resell them. So for the underwriter, the underwriter looks at the price it gets. The price for investors, it will subtract its cost to acquire the securities. So it looks like profit there, doesn't it? Well, this type of profit, that's called the underwriting spread. And for those of you online, let me stop my share for a moment, show you what I wrote. So again, what an underwriter does, it buys or acquires securities from the corporation issuing them, could be stock or bonds. It will turn around and sell these to investors. It hopes the price it gets from investors will be greater than its, well, cost of goods sold, if you will. If it's positive, a positive difference, that's what the underwriter wants. Again, that difference is called the underwriting spread. Do you think the underwriting spread could be negative? Yes, it could turn negative. As many times. That's one way in which underwriters are subject to a lot of risk, because they can turn a loss quite quickly. But of course, if you want to make a lot of money, you have to take risk. What every underwriter's dream is, they will acquire securities from the corporation issuing them. Like an IPO, an initial public offering of stock. And then this IPO price will do what? Take off, yeah, really soar, as some have. So that's a lot of money to be made. On the other hand, if that IPO price crashes, a lot of money can be lost too. That's one way in which an underwriter has a lot of risk. Another way in which an underwriter has a lot of risk is that the underwriter is mentioned in the Securities Act of 1934. So the SEC has a special category the underwriters fit in. So underwriters have to be registered with the SEC. They have a lot of risk that way. And the SEC is looking to see if they do something wrong, such as mislead investors. Or if the underwriter does not exercise what is called due diligence, basically due care. In other words, if the underwriter did not check out the corporation securities to the extent they should before they sell them, they must. They're a so-called expert under the Securities Act of 1934. And if you're an expert, and the auditor is too, that means you've got to exercise due diligence. You've got to do everything you should, just like we exercise due care. Same sort of a deal. So underwriters have a lot of liability. As a result, they may ask for a special letter from the company's auditor. So a special letter from the company's auditor that talks not only about the audit results, but some other information too. So that is called letter for the underwriter, or sometimes called comfort letter, same thing. Because the underwriter is trying to get comfort from the auditor. Now, comfort letters will be the subject of this pronouncement here. And primarily, we will see what the auditor can and cannot say in a comfort letter to an underwriter. Because if we say too much, well, we've opened ourselves up to a lot of risk. If we say too little, the underwriter is not going to be satisfied. And by the way, these are not mandatory. So if we don't say enough, nobody's going to pay us. It's an optional engagement, but very, very commonly done. So let's see what we can say and cannot say. And yes, there have been lawsuits against auditors in the past for these. Primarily because we said too much. So if this type of letter opened the auditor up to some risk, why do you think the auditor simply doesn't say no? I'm not going to write this. What's driving the auditor to write these? Money. No, these are profitable. Sorry.
They must be a considerable amount of money.
Yep. Absolutely. So as I said, they're optional. They're never filed with the SEC, by the way, never. They're always very restricted in distribution. Because this information you don't want getting out there in the hands of others. Does anybody know who the world's largest underwriter is? No. Yes. Pardon?
I don't know why.
No. Okay. I think they're based out of London, I should say, the world's largest underwriter. It's either there or New York. I think London. It's hyphenated name. Oh, they're long gone. Hyphenated, but things are Jewish. No.
Probably number one.
For insurance. Yeah. Okay. You'll recognize it instantly. Goldman Sachs. Yeah. Now, an underwriter may sell stock or bonds to other underwriters. Underwriters usually deal with big sales. They could sell stock or bonds to other underwriters. They could sell them to institutional investors, including mutual funds. So again, they're dealing in big transactions. Or they could sell to broker dealers. And that's another category under the Securities Act of 34, a broker dealer. You hate that word?
Yeah.
Why is that?
Oh, that potential over the past summer, and it was just like everywhere, but I was like, are they a broker or dealer? Like, yeah, they're a broker dealer.
Oh, yeah, they're a broker dealer. I see what you mean. Yeah.
Like,
Prudential is a big broker dealer. Absolutely. They've had a lot of transactions with Goldman Sachs. So a broker dealer is the next step down the food chain. So here's an issuance of securities from a corporation. The underwriter sells those securities, stock or bonds. So they'll sell a few big transactions usually. So one big transaction to Prudential being broker dealer, another big transaction maybe to another underwriter, a big transaction to a mutual fund, a big transaction to a corporation, a society to invest a lot in this. So the underwriter considers it to be worthwhile. Then broker dealers sell usually in smaller amounts. And they may even sell to individual investors, very frequently do. For example, a lot of banks have broker dealer divisions. That's right, are they a broker or are they a dealer? Something to ponder. Yeah, or we could say broker dealers are neither brokers nor dealers. Discuss. Sometimes broker dealers also request comfort letters from auditors. If anyone other than that named underwriter requests a comfort letter, they have to have what's called letter of representation. It's issued by their attorney. And it says that they need the comfort letter because they are also an expert under the Securities Act of 1934, and also must exercise due diligence. So if anyone other than that named underwriter requests comfort letter, they've got to send the auditor a letter of representation from their attorney stating that they are an expert under the Securities Act of 34 and therefore need to exercise due diligence and therefore need the comfort letter. But that's just one good way to keep from the auditor's liability getting to be too big. Again, we don't want these going out just to anyone. I'll pick up a few additional details they hand out in just a little bit, as you can tell, I'm summarizing it. Basically, what should we say and not say in a comfort letter? Well, being an auditor, we tend to think in terms of assurance. So we can give, well, 3 types of assurance. Actually, I should say 2 types of assurance plus no assurance. Okay. So the level of assurance we can give it could be positive. That's an opinion. could be negative. Also known as limited assurance. Or it could be none. I will tie that into the type of information. First of all, for information that is closely derived from audited financial statements, we can give positive assurance on it. We believe it's okay. No problem. Then, negative or limited assurance. It says we find nothing wrong with this information. Whereas positive assurance says we believe this information is okay. Negative or limited assurance says we find no reason to indicate this information is wrong. It's a lot less far-reaching in terms of assurance. We can do that for any other information which falls under our expertise, and that's our own judgment. So any other information which is within our expertise. So it's not directly derived from audited financials, but it is somehow within our expertise. We can give negative assurance on it. Finally, if we give no assurance, that is information which is outside our expertise. As you can probably guess, the underwriter wants us to comment on as much as possible, including even information which is outside our expertise. They would love to get some assurance on that. And for some of the stuff for which we give negative assurance, they would love for us to give positive assurance. But we don't fall for it. That can open ourselves up to life. By the way, with this information, which is outside our expertise, that would include evaluating the legality of something. As always, we never evaluate the legality of something like some transaction. An attorney would get very upset. We never evaluate the competency of some party. So never evaluate the competency of some party. For example, maybe the underwriter would love for us to comment on whether this corporation's management seems to be competent to run the place or not. Let's never do that. So I got way too many toes there. And we never vouch for the achievability of something. Like the company's forecast income for next year. We would never vouch that that will come true. Of course, the underwriter would love it if it would, but that's obviously opening up a big can of worms for us, liability-wise. And also, obviously, the full-blown financial statements must have been audited. But we need not be the auditor of them. So another CPA firm could audit them. And then we could do the comfort letter. That's not very common, but it could happen. I always thought that was kind of a curious sort of loophole there. But no, we need not be the auditor of the full-blown financials. Now I will glean a few details from the handout. Any questions so far? Right. And for those of you online, I'm going to go back to sharing my screen. Just a few other things. Remember, comfort letters are never required by anyone, including the SEC. Underwriters commonly request them to limit the risk. In fact, we would never file one of these with the SEC. So the applicability, I mentioned the due diligence that we have. So accounts may provide a comfort letter to underwriters or other parties with a statutory due diligence defense, like some broker dealers, in connection with financial statements. A financial statement schedules included in registration statements like Form 10K filed with the SEC. So all these parties have to show they've exercised due diligence. And if what they do is ever called into question, well, they can show the exercise due diligence, due care, and therefore they shouldn't be held liable. Just like the auditor shows the exercise due care, and they shouldn't be held liable. Well, see, as we mentioned, a broker, dealer, or other financial intermediary must furnish the accountant with a representation letter. So anyone other than named underwriter must get a representation letter from their attorney saying that they have a statutory due diligence defense too. It's a major way to limit our risk as an auditor. Then B, here under Roman numeral 3, I mentioned that a lot of uncertainty and consequent risk of misunderstanding with regard to the nature and scope of comfort letters as arisen from a lack of recognition of the necessarily limited nature of the comments that an accountant can properly make with respect to financial information. A registration statement or other offering, like Form 10K, does not fit audited in accordance with GAAPs, and accordingly is not covered by his or her opinion. So in other words, The underwriter tries to get us to say what? We know that we can't. We've got to limit what we say. If we say too much, our liabilities just went way up. On motion, here's one. Now, what should be in here? What should be in this letter? Well, here and see what constitutes a reasonable investigation of unaudited financial information sufficient to satisfy an underwriter's purpose has never been authoritatively established. Only the underwriter can determine that, what's sufficient. So the underwriter meets with the auditor. They decide what information should be in. We always let the underwriter make the final decision. Reason is they know what's sufficient. We do not want to be accused of not giving sufficient information. So we let them make the final decision. Let's see, guidance on the format and contents of cover letters. Always, we should say that we're independent. Then, as I said up here on the board, with this positive and negative assurance, we can give it a comfort letter. Well, if the accountant has audited the financials, again, we need not be the auditor, but we almost always will be. We may also give positive assurance in that case on whether the audited financial statement schedules, including the registration statement, compliance to form in all material respects with the applicable accounting requirements and the related published rules and regs of the SEC. So give positive assurance on something which is audited or closely derived from it once again. Then negative assurance on anything else which is within our expertise. Sum that. Negative assurance on anything else which is within our expertise. And if it's outside our expertise, give no assurance on it whatsoever. With dating a comfort letter, it's ordinarily dated on or shortly before the effective date of filing. Make the effective date of filing at Form 10K. And the addressee of this, well, was limit distribution. Letters should not be addressed or given to any parties other than to the client and the named underwriters, broker dealer, financial intermediary, or buyer or seller. That's correct. That's there. There's various types of information gets into too much depth. Okay. Any questions on letters for underwriters? Well, just a few review questions here if you'll do those for homework. And the solutions, by the way, are in the files for you under files on Canvas. Let's see this. There. Anything else there? Pardon? No, actually. just for your own clarification. Anything else here so far? All right. Just double check here back on my syllabus. One thing left, and that'll be the review of interim financial information. So I'll tell you what, I would rather not have to break in the middle of that. So I'll do this. I'll go ahead and review one of the homework problems. So if you haven't done it, that's okay. But the problem I would like to review with you is the one that we had in this handout right before summary financial statements about Smith CPA. And this actually pertains back to special reports. So again, this one you don't need to turn in or anything like that. That's just for your own information. So we'll get this mailed away, and then we'll do the review of interim financial information on Wednesday when we don't have to break, and then we'll do the rest of the homework then. So just kind of switch this around. So here in this little case, Smith CPA, audited financial statements for a utility. These statements were prepared on the basis required by the State Regulatory Commission. So not just GAAP, but the State Regulatory Commission, since this is a regulated industry, may want certain numbers which are not GAAP. For example, it's very common with these to want non-historical cost of assets, but instead current fair market values. The Regulatory Commission wants that so it can calculate return on investment on those current fair market values and make sure the public utility, like the electric company, is not too profitable. It's not earning too high of a return on investment, not ripping customers off, shall we say. So that's okay. We have to go forth and do this. Well, as a result, Smith did not evaluate the accuracy of disclosures in the financial statements. By the way, the first thing we're due is to evaluate Smith's approach. The answer is this is bad. Smith must evaluate the accuracy of disclosure. Those financials should have the same disclosure as in GAAP-based statements. Same disclosure as in GAAP-based statements. With one additional disclosure. That additional disclosure, that additional footnote, will talk about the basis of accounting they are using. So in that additional footnote, the client will talk about that basis of accounting they are using. Obviously, Smith needs to make sure it's in there. Smith issued a claim opinion, even though he was uncertain about the realization of certain receivables on the balance sheet date. It means that for these customers paying, Smith wasn't sure if they were really going to pay or not, or if these were bad debts. So if Smith has not cleared up this question, by the end of the audit, Smith is left with the scope limitation. This could result in either a qualified opinion because of scope limitation, or if bad enough, a disclaimer of opinion. We see that Smith disclaimed an opinion on last year's statements, which were presented along with current year statements, but made no mention of this in the current audit report. That's bad. Remember that we always have total disclosure, total transparency, cover all years of financial statements presented. So since last year's financials are presented along with the current year's financials, Smith must disclose everything in last year's audit report. Again, total transparency. Now, second, if the Regulatory Commission requests a separate report on compliance with specific regulatory requirements, could Smith issue it? What items should be included? Well, as long as Smith does not issue a disclaimer or an adverse opinion on the full-blown financials, then Smith can issue this separate report. So it's that supplemental report about compliance we saw. Smith can issue it as long as he does not issue a disclaimer or adverse opinion on the full-blown financials. Item to be included will be negative assurance regarding compliance with whatever requirements the Regulatory Commission wants. So give not positive assurance, but negative assurance regarding compliance on these items for which the Regulatory Commission is requiring compliance. Number 3, should distribution of these reports be restricted? Okay, for the compliance report, yes, always. For the audit report, the default is to restrict distribution because the financials are in accordance with the basis required by the Regulatory Commission. So for the audit report, the default is to restrict distribution because the financial statements are in accordance with the basis required by the Regulatory Commission. However, as we saw in a lot of states, these will be made public information through the Sunshine Law, or in some states called open records laws. And in that case, we say, okay, these financials will be a matter of public record and distribution need not be restricted. So for the audit report, if the financial statements will be made a matter of public record, then distribution need not be restricted. Any questions on that? Well, very good. That's what I've got for you today. So we'll do interim financial information on Wednesday and do the rest of the homework. All right. Well, have a good evening, and I'll see you back on Wednesday for our very last class. Just managerial, and then the rest of them are graduate.
Well, I guess my last class.
Guess it will be unless you decide to take the math.
I don't
You know, opens up a lot of good opportunities.
I mean, I don't think it's really-
The CPA. A whole lot.